Hey there, Mark Yagi here. Welcome back to the channel. And we're in kind of a red market right now, which means you shouldn't be buying a lot of stuff. But if you're going to buy something, you want to buy something with some good strength. And one of the things that I've discovered today is something I'm taking a look at. It's called Google. You might have heard of it. G-O-O-G is the symbol, but the stock is really called Alphabet. Anyway, let's take a look at this chart. So if we look at the chart, you can see this is on a nice uptrend. It's trading above its 50-day, it's trading above its 200-day, it's trading above its 8-day, it's 21, it's 20, it's 10. It's trading above all the major moving averages, and that's in a lousy market. It's a red market. So you can see there's a relative strength rating on the stock of 89, which means it's performing better than 89% of the other stocks in the S&P 500. It has moved about 30% in, say 4 or 5 months. So that's pretty amazing, actually, for such a big company. So that means they're doing some things right. So let's take a look at some covered calls that I'm evaluating on it. And I'm just looking to go out 10 days. And so the covered calls I'm looking at, the stock is right now at 130.25. And so I'm looking at going out 10 days, which is next week, because today's a Tuesday, and we're looking at going out to next Friday. And just selling pretty close, right at the money, just slightly in the money. It's a $130 stock. 130.25. I'm going to sell the 130s. I'm going to pick up $2.83 for those. $2.58 of that is the time premium, the juice. That's what we're going for. That's really the whole point of the trade, is to get that $2.58 juice. And here's the strategy. If we like Google next week, we stay in it and we roll the calls and we keep just reducing the basis in our stock. If we want to be out of Google and it's above 130, it gets taken away automatically next Friday. So it really depends on what you do. Normally, I like to stay in a stock for a very long time, but I'm taking a look at this one as a short-term consideration. So let's go to the calculator that I put together here, and I'll show you. So here you put in 130.25, 130.25. The short call is $2.83. It's a strike price of 130, 500 shares, and it's a 10-day deal. Those are your inputs. The position cost all the way down at the bottom is $63,710. But you're looking at making $2.58 in juice. That's exactly 2% for the 10-day period. And of course, it calculates if you could do that over and over again, for that 10-day period, and you can multiply that 10-day period over the rest of the year, you get 74%. Very not bad, especially if you were thinking that the stock is bottoming here, or it's not going to go down significantly. Even if it does, you just sell the calls, and if you can make $2.50 something cents a week, in 50 weeks, you're talking about, $100, $125 or something like that. So, it's almost the stock price. So that's the beautiful thing about covered calls, is that's the engine to keep you in the stock. So that's how I'm looking at it. Hope that helps you. If you like what we're doing here, I'm just giving you ideas. This is education. This is not financial advice. This is information and fun. But hopefully you kind of see what we're doing. If you like what we're doing, hit the subscribe button. Hit the notification bell so you can find out when these come out. Maybe you want to take advantage of some of these, but that's up to you. Also, I'm having a income accelerator program. It's a live 5-week training. If you're interested in finding out a bit more about covered calls, what we do here, things like that, you can go to cashflowmachine.io/5-week workshop, and you can find out a little bit more about what we're doing, get on a mailing list, and then maybe even get some free training prior to the program. See you soon.